Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending May 19th, 2023. I'm Preston Brent. Thanks for tuning in. This week's theme really continues from last week, and it's the debt ceiling debate risk still are overhanging the market right now. So let's take a look at where we ended up this past Friday at market close and just a couple of things going on from an economic data perspective. Then we'll take a look at the charts. If we look at it, everybody was solidly in the green this week. In fact, the Russell moved back into the green year to date. Everybody's solid, but look at NASDAQ. The outperformance here is setting records with NASDAQ. In fact, the outperformance of the 5 largest stocks in NASDAQ, especially the Fang, is almost 20 to 23% of the total SPX index. Okay, we're looking at the S&P cash index. It breached the 4,200 level intraday for the first time since last August last year. But we've been kind of range bound for the past few months. And last week's close, not this week, but the last week marked 6 consecutive weeks where we failed to move by more than 1% during the week at the end of the week. That's the longest stretch since November 2019. So that means there's a lot of energy built up in the market. But with the debt ceiling debate risk as an overhang, I don't think we're going to get too far north of the price until a lot of that issue is resolved and put behind us. I mean, the catalyst for this week's gains tended to be initially when Kevin Hardnuts McCarthy basically calling a deal doable over the weekend, in the middle of the week. Although the markets tended to waver a bit on Friday after the lead negotiator for the Republicans announced they had decided to press pause until the Democrats get serious. But just understand, next week it's going to be a battle of the dueling podium. Let's run to the press and blame the other party kind of thing. All of that net tends to increase, or at least give the volatility a little bit of an increase in movement. And looking at vol, you can see that it was up just a little bit on the week, even though we had a strong week across all indexes, right? I mean, you can see the VIX was up the prior week. It's pretty much a little bit flat, really. Let's just call it flat. I think we'll stick with that. The PE ratio is still, I think, flat from the trailing to the forward 12-month guidance. It's still higher than I would like to see it. Dividend yield, 10-year Treasury is about 197 bips over the 10-year or over the dividend yield. The earnings yield is still over a healthy 5.28%. With the S&P. Earnings for Q1, even though it was negative, came in much better than the markets expected. Going into Q1 earnings, the markets were expecting a year-over-year negative earnings of over 6%, but it came in at a little over 2% negative. So much better than expectations. So we're seeing some of that. Consumer, while pulling back a little bit, is still healthy in their spending. And all of that tends to help out the markets. You can see the best performer for this past week, technology. Worst is utilities. Both one over 4%, one under 4%. Utilities really got hurt this week as it was a big risk-on type of week. Markets were going for growth, and that's what we saw in technology. Year to date, the best performing sector, communication services, up a whopping 28.31%. Energy bringing up the rear, a negative underwater 8%. Of course, it was just the opposite in 2022. So we're seeing a complete reversal on 2022 versus 2023. I mean, we did get retail sales this past week. It came in below consensus expectations. It was the slowest year-over-year pace since early in the pandemic last year. Okay. And we're also seeing weekly jobless claims came in a little bit below expectations, showing the markets are a little bit stronger, which obviously any economic data point that shows the strength in the markets continue, like tighter labor market, tends to put a little bit more upward pressure on the Feds not to pause their interest rate hikes. Although the 10-year Treasury note came up sharply over the week, mostly because of strong higher jobs and manufacturing data, right? But the markets, just as a reminder, are still pricing in a rate cut at the June Fed meeting, okay? Meanwhile, let's take a look at Europe. If we look over at Europe, you can see everybody is solidly in the green. The Euro stocks, FTSE, CAC 40, DAX. They're up very strong, double digits except for the FTSE. Leading the way is the DAX, German index, over 16.89% year to date, okay? Although we're starting to get more signals that Europe might be sliding into an industrial recession, okay? The Eurozone industrial production sank about 4.1% in March. And that was after moving up 1.5% in February. But the year-over-year basis, the industrial output declined 1.4%, okay? And meanwhile, we got the European Commission. They raised their forecast for the Eurozone economic growth this year and next, and did predict inflation is going to remain stubbornly high. So that puts a lot of fear, and the central banks are not done with their interest rate hikes. But the Euro Commission, their latest projections call for the GDP to expand 1.1% this year, which is still very, very low. It's almost flat, and 1.6% in 24. All right. But that's up from the previous forecast of just 90 basis points this year and 1.5% last year. And wage increases across Europe are expected to drive inflation to 5.8% in 2023 and 2.8% in 24. So I suspect that the ECB is going to be forced to not pause. Remember, they haven't done the number of rate hikes that the U.S. has done, the U.S. Fed. So I believe they got another rate hike in store for them over there. Meanwhile, if you look at Japan, the Nikkei, huge numbers for the week, 4.83%. Huge numbers year to date, 18.06%. I mean, the only one ahead of that of the major countries globally is the NASDAQ, right? That you don't normally see those kind of moves. So why so strong? Well, Japan's GDP expanded at an annualized rate of 1.6% in Q1. That was ahead of expectations. And there is a resurgence in consumer spending in Japan and business spending, okay, while they ease COVID restrictions along with China. And the Bank of Japan governor, Ueda, basically reasserted that the central bank is committed to patiently maintaining its ultra-loose monetary policy. They really want to see inflation come in strong multiple months before they start to tighten their yield curve control measures. And that, folks, is when we're going to jump in for our members. We're going to jump in on long yen because it tends to trend a lot. So going long yen dollar is going to be a great trade for us when that happens. Okay. Meanwhile, if we look at China, they were in the green. Hang Seng, the Hong Kong index, in the red, and in the only index really year to date that's in the red. Chinese equities are mixed. There's a concern that coming out of their post-COVID recovery in December, their markets are losing momentum. We're seeing industrial output, retail sales, fixed asset investment, all of it growing weaker than expected in the month of April from a year earlier. So there's some issues over there. We're also, there is a higher unemployment rate. It fell to 5.2% there, but the youth unemployment is at a record 20.4%. China's going to have to fix that, right? But China and Japan are still really the only countries right now that are putting money into the economy. They really want to drive the economy there. I think Japan will probably end sooner than China. And that's when we're going to want to look at going long the yen, all right? What I want to do is switch the screen over. We'll take a quick look at the charts here on this weekly roundup. Let me just get this over here. I'm going to move you over to a different screen right here. It'll take about 15 seconds for the screen to come up for you guys. And we'll start off as we always do with the E-mini S&P 500 futures. And then you guys are going to be able to see just how strong this market is holding up here, okay? And if we look at it, what you should be seeing now is the S&P 500 E-mini futures. You can see we made a new high on Friday, intraday, before it backed off a little bit. We're right at my target. Now, my target is not well formed, but my target was right up here around 42.31, if you guys remember. All right, and we got a classic 3-4-5 Elliott wave pattern. We're setting up with a classic divergence. We call this divergence a poor man bed, which would suggest we are going to get some downside movement. Now, I've told our members that I would expect downside movement until we get this neutral to downside movement, until we get this debt ceiling debate risk off the table. And I think these guys are going to take it to the end extreme. So that's why you got to be careful, guys, on this. I was adding up some puts. Volatility is low right now. So for those of you that are hedging, I went through a hedging in our Option Masters program with our members this past Thursday evening. There, and in our Option Masters series, I have a number of ways of managing risk, whether you're portfolio margin or a Reg T margin account, whether you're using a SPY or you're using a sophisticated form of pair trades using volatility futures. There's a number of different ways you can hedge. But right now, net VIX is lower than normal, so this is when you want to be looking at adding into your puts, because they're a lot cheaper than they would be once or if we come down. I think we're going to move back down a little bit, possibly down to the 4,100, down to 40.50 area, down in this area here before we get going again. And the big primary reason is the market's going to start pricing in issues with its debt ceiling debate. We'll get more information next week. Just anticipate dueling podium rebuttals from the Repubs and the Dems as they blame each other on why we're not moving anywhere. But that's enough to move the markets off center line here. But still a strong move up, over 9.29% SPX intraday high. Okay, I mean E-mini S&P high. If we look at the strongest of the bunch, NASDAQ, huge numbers. All right, again, May 19th, 2023 high, up 26.93%. And in the NASDAQ 100 futures, almost 45 to 50% of that value is just the FANG. It's huge. So when you're looking at this, you might as well be trading the Qs, really, or the FANG index, or just having a basket of FANG stocks, because this is what's happening. All right, and if we look at the FANG index, you'll see that's up even more, of course. It's up 50.96, let's call it 51% through Friday's close intraday. Huge numbers. All right. Now, I expect this gap will be filled. Will we fill it before we come through the end of May? Maybe 20%, because money seems to be flowing into these mega cap FANG stocks. And with AI spurring on Apple and Google now, Microsoft and Meta, each announcing their own AI initiatives, because that's where the money is. It's almost like, reminds me of when blockchain became popular short term years ago, and you had companies just all of a sudden becoming blockchain companies just to bump the stock 10 or 15%. So be careful on chasing these price action up here, because I do believe we're going to settle in a little bit. Okay. And NASDAQ's been on a tear, or FANG's been on a tear all year long. You can see the low for 2023, very close to the closing price of 2022, was back in early January. Otherwise, we've just been on a rocket ship straight up. Okay, if we look at the Dow, you can see with the Dow futures, we're kind of just barely in the green for the year. All right, Dow is under. We haven't seen a divergence between NASDAQ and the Dow like this in decades. Okay, normally NASDAQ will lead because it's a higher beta index, but not by that much. And what's happened is because the breadth of this market has gotten so thin and so narrow, it's like we're sitting on the top of Mount McKinley without oxygen mask on, right? And your lifespan up there is very low unless you start breathing some air. So we're going to watch for this. Be very careful with these markets, okay? And fortunately, the VIX is, fairly low right now. So picking up puts or doing put spreads is relatively inexpensive, and that's what you guys might want to be looking at here. All right, for our members, we've gone through it before, but people tend to forget, okay? And of course, let's look at the Russell. The Russell is just barely in the, in fact, we moved back into the red. Intraday, we were in the green. We closed in the green on the 17th. We maintained in the green on the 18th. These are Russell futures now, not the Russell index. And then if we look at the where we closed on Friday, we moved back into the red again, just barely. But where you could see where the rut is having a hard time from the futures perspective of climbing over it. In fact, we couldn't hold the 50 EMA. We only held it one day and then we gave it up. All right. My target for the rut was really down here around 1676 for the year, for this year. We came very close over here at 1703 on March 24th, but we've just been chopped, going sideways chop. Now I want to show you something. Let's take a look at the SPX. This is the cash index. You can see here, it also made a new high right near our fib level up here at 42.17. And that's going to prove to be strong overhead resistance until we get that debt ceiling debate done, right? You can see the bearish divergence set up here in the MACD as we moved higher. But let me show you just how thin this breadth is. Now, this is the SPX. That's where Apple and Microsoft and the FANGs account for almost the market cap of those stocks for about 25% of the entire S&P, right? So when those guys are doing well, as they are this year, then it helps pull the S&P up. All the other stocks are not doing nearly that well, dramatically underperforming. Let's look at the equal weight SPX, which is assuming every stock has 1/500% ownership in the S&P. If we look at that and look at the year-to-date performance, we're barely, almost like the Russell, we're barely in the green. I mean, just barely, okay? So that just shows you the outperformance of those FANG stocks, those mega cap stocks, right? So we need to be very, very careful here in just how this market is moving, all right? Very, very careful. Now, I'm going to come down here and let's go take a look at treasuries. If we look at the bond market, okay, bond market is going to be tricky. The reason why it's been coming down hard here is we've been getting stronger than expected earnings, stronger than expected economic data. We'll get a bad data point here or there. And the economic surprise index put out by Citi shows it's moving higher, not lower, which means we're getting upside surprises more so than downside surprises in economic data. That puts more pressure on the Feds to keep the rates higher for longer. All right, remember, the bond market moved off the lows here straight up because the bond market is still pricing in over an 85 or 90% chance of a rate cut in Q4 of this year, like over 60, 65% chance of 2 rate cuts this year. So the bond market, and anticipating that, moves higher, interest rates move lower. But now the Feds are being a lot more steadfast in their comments that no, we're not going to do that. We don't see that. So the bonds is going down. And what that does is it drives interest rates higher, as I'm going to show you the 10-year right here. Let's see here. So here's the U.S. 10-year. Look at this. It's moving straight up as bonds are moving straight down. Okay. It's saying, okay, maybe the Feds are going to keep the rates higher for longer. Okay. Near term, expect this pattern to continue. Okay. Expect it to continue. If we come down and look at the dollar had a little bit of weakness, but it is still strong versus the euro. The dollar is moving up big time here. All right. Big time. And we're seeing that because the bond market is saying we're going to have a higher probability of recession in Q4. Inflation will be lower. The Feds are going to be forced to cut their rates. That tends to give the bonds a little bit of strength. I mean, the dollar a little bit of strength because the Feds are going to be forced to react to it. And in a looming recession or a looming recessionary environment, money seeks safe havens, and one of them is the U.S. dollar. Another one is going to be the Japanese yen, but I think the yen's going to be going up for other reasons. Not right now. You can see the yen is already taken out this low here. Not much of a divergence, but I suspect the yen is going to be moving up. Remember, over here, each of these white lines represents 1 month in time. The reason why the yen was moving up here is this was before the Bank of Japan governor was going to be appointed, but everybody thought it was going to be Ueda, and he came in April. Right over here in April. Right here is when he came in. And then his first meeting, what did he do? Everybody thought he was going to reduce the yield curve control and strengthen the yen by taking some of the stimulus out of the market. That didn't happen. And then here we go with the yen. I don't think it's going to come back down to these lows here. It'll probably reach about 60%, 61, do a fib node, probably 61%. It's going to hold up here, and then away we go again. So members, we'll go through that. I'll review it a little bit more on Sunday evening in our weekly market watch. The euro, same thing. If we enter into a recession, the euro is going to go lower. All right. Now, I think it's going to hold up around this level here, and then we're going to move higher. I think right now, any rise in the euro is not worth buying unless we're over the 50 EMA. Otherwise, hold off. But I think our time for long euro will come, just not right now. Okay. And then, of course, if we come down here and look at gold, longer term, I'm long gold unless or until we're above the 50 EMA. I think gold, any rally here, believe it or not, is probably going to be sold off with gold. We've had a couple of quick rallies here. We had divergence in the MACD that suggested I was getting our members short up in this area here, right? And it's just I think we're going to have any rally net is going to be a rollover in the gold market. Silver, same thing. It's got a higher beta, so it'll come down faster. You can see the beautiful divergence there. You know, you get a short signal here on May 9th, May 10th, and that's what you want to do. Just pick it up and then ride it down. I think it'll move back into the red for the year and consolidate at a lower level, and then we'll move higher. Okay, that's kind of how I'm seeing that. In fact, I'll let the system calculate it, but I think silver can move back up in the high 20s again, just not right now. Okay. Energy, we're going to be stuck in a trading range. After moving down very hard, we're stuck here. This is a great area to do our strategy in oil. Sorry, stuck in this trading range. We're going to be in a great. Our trading strategy for oil works out very well in markets like this with oil. Longer term, I think it'll be neutral to slightly bullish, but we're probably going to stay red this year unless we get some kind of geopolitical event out of Russia and Ukraine. OPEC is already on record as saying they want to cut production. They already cut 1 million barrels, but I don't think Russia's following them very well. They got another OPEC meeting next month. So I just think the risk of a bigger move right now is not down, but up. If we go into a recession, oil does not perform well in a recession. It tends to sell off. So we were actually intraday in a bear market in oil, down 20.95, but we didn't close in a bear market, but we just, it's kind of a quick sell off here. People stops were being driven out, right? Sell stops, and they just sold and away we went. And if we look at Nat Gas, another great one to trade. I love this trade. Our members, I've been talking to our members about it. Nat Gas down at this level, the risk of a bigger move is upside, not downside. You don't really see Nat Gas under 2 for a very long period of time. For those members that took our trade over here, we were shorting Nat Gas back over here when we didn't know what the winter months were going to be like in Europe. Shorts over here in this peak, shorts over here in this peak, and we did very well in Nat Gas. So guys, that's a quick and dirty on some of the key markets and some of the different asset classes. Members, I'll see you this Sunday evening for our weekly market watch. Next week, every day, debt ceiling, debate, risk are going to remain until that gets resolved. I think it's going to go to the end like every other one, but it's going to keep volatility higher for longer. And any podium statement done off key is going to send the markets down for that day. All right, folks, have a great weekend. Members, I'll see you this Sunday evening for our weekly market watch. Ciao, folks.